Welcome, everyone. Today, we're here to talk about Magnifi by TIFIN, a marketplace where you can harness real-time proprietary data to help individual investors and financial advisors find, compare, and buy investment products like stocks, ETFs, mutual funds, and model portfolios to grow and preserve wealth. I'm Gary Kaminsky. I know just a little bit about the subject matter as a former vice chairman of Morgan Stanley and former capital markets editor at CNBC, and currently a board member and investor at TIFIN, the parent company of Magnifi. We've spoken about best crypto investments with Anthony Scaramucci, best equity strategies and investments with hedge fund manager Kyle Bass, and best bond strategies with the bond king himself, Jeffrey Gundlach. And now we have a very special guest talking about commodity investments, my friend Mark Fisher, the CEO of MBF Clearing, a New York-based brokerage firm. Mark, thanks so much for joining us today. What a great pleasure. Before we get into commodities and oils, I just want to talk about your career. I know you've done a bunch of interviews over Business TV. We've obviously known each other for in excess of 40 years. Some Long Island legendary folklore about how you began trading commodities. So tell us, when did you start to trade and how did you get into the business?
The way I got in was luckily was from one of my neighbors down the block, who I didn't really know what he did for a living, but I kept seeing him buying a new car every month. I basically banged on his door and made a business proposition with him, whereby he allowed me to tag along at the age of 13, 14, 15. And in return, his son, who was my age, I agreed to tutor and help and manage him through, how should I say this nicely, through high school. And that was the deal we made. Little did I know that I would end up on the floor of the Commodities Exchange in New York, in the silver pit, in the days of the Hunt brothers, of the late, the 70s and in the early 80s, going ahead and watching the entire silver, story play out in that time frame. And that's how I got started.
You have, I know, many of the viewers probably don't know, you've been a mentor for generations of young traders. It's something you pride yourself. You've done an exceptionally good job. If you had to pick out maybe 2 or 3 of the characteristics that what makes up a great trader, I think people would be surprised at some of the thoughts you have. So if you're going to tell young people, what do you need to do to be a great trader? What would you say?
It goes back to how well you can multitask and how quickly you can process information. I'll give you a story. One year we had someone start who had just graduated top 2% of his law school at Harvard Law. At the same time, I had someone start from Atlantic Beach, who was an ice cream vendor, who was basically, you go up to him, 50 kids would go up to him, and he would know all 50 orders. You got this, you got this, you got this price, this price, this price. And I basically started them at the same point. And I don't need to tell you, Gary, who ended up becoming a legendary commodity trader and trading and had an unbelievable run in the pits, and who ended up going back to practicing law. I mean, so again, the 4 steps of the decision-making process: accumulating data, analyzing data, deciding data, and implementing. The faster you and the better you are at that, the better of a trader you're going to be. Maybe not as an investor, but as a trader.
Yeah, and that's very important. And it's very important. And while this is something I've heard you talk about for many, many years, I thought it was important to share before we get into some of the way the world looks right now in terms of those kind of important skill sets. So Mark, let's start off with crude oil. Maybe 5 weeks ago, we've had this massive move to the upside, which started right after Kyle Bass had joined us actually with the war in Ukraine. I know you had been talking about for some time the upward move in crude even before the war. How do you see things now? We're about 20%, I think, off of that short-term high. How do you see the crude oil markets now?
Well, again, like I said to other people, can't get into Putin's mind what's going to happen, because those are all outliers. But the market was going to $120, Gary, with or without Ukraine. Okay, and what ends up happening because of Ukraine, everything just got fast forwarded. Now you've got, with the China COVID situation taking place, with the short-term SPR release, I'm not sure exactly what happens in the front of the board and crude, whether we stay at 100, whether we go to 120, whether we go back. We're not going below 80, 85. But I don't know if the refined products are probably a better way to look at it, because I think that no matter, even if there's an SPR release that doesn't release gasoline and heating oil, and there's so much demand for distillate all over the world. So I think if I was an investor today, I'd want to invest more in the refined products than actual crude oil. Can crude oil go down $10? Yes. Can go up $20? Yes. But the risk reward isn't there anymore in crude oil for me. The risk reward is more in believe it or not, in crack spreads, which is the relationship between heating oil and gasoline and crude oil. The back of the board of crude oil, because obviously the market's in backwardation, which means that the front of the board is trading at a significant premium to the back of the board. And I don't think we're going down anymore for various reasons, including the fact that the government has to buy back this SPR reserve in 18 months to 24 months. I do think, though, that the bigger story, and I've been talking about this for the last couple months, is going to be in natural gas. Because with natural gas in this country trading now, it's gone from $4 to $7, and we've been, basically long the whole way up. And I'm sure it's going to come off today because there was a bullish stat report. Just that's the way things work, right, Gary? You talk about something that immediately goes down 5%, but in reality, between now and October, the path of least resistance is up, because with natural gas trading $7 and everyone going to produce as much as they can to export through LNG, if we have enough facilities, which we won't. Where Europe is saying that they want their natural gas reserves to be full by 90% full by October 1st, before the whole winter happens, right? Who's going to go ahead and sell this winter's natural gas at $7.50, when natural gas in Europe traded $300, when Europe is trading still $32 now? And so to me, the risk reward is, if you see a dip in natural gas prices, that's a much better risk reward trade to make between now and October. Once the winter takes place, then it becomes a weather situation. I'm not as sure, but between now and October, it seems to me that that's the best risk reward play by far on the board.
When you talked about analyzing data, accumulating data and then analyzing data. So if you're long natural gas or you're long natural gas equities, what are the type of things that you want to be paying attention through the summer?
You want to be paying attention to a couple of things. Again, everything that everyone looks at becomes meaningless, because if everyone sees it, how good can it really be? For instance, there was a bullish stat in natural gas today, right? The market rallied. Let's see if the market holds its rally. If the market ends up having a good news to the market, which is a good stat, but later in the day sells off, to me, that's a short-term bearish signal. The same way, if there was a bearish signal a week or two from now, and the market discounts it and just rallies, that's a bullish signal. That's the first thing. So again, the second thing about it is, I would look to see what's happening, in natural gas. What's happening to the open interest? How is the open interest moving to the winter months? Because eventually the index funds lead the charge to the winter months. Right now, obviously, May is the spot month. Eventually, that shoulder season has to migrate to the summer and then to the winter. Well, who's selling 250,000 contracts in winter natural gas? It's no longer the producers. As you see, if you read the FT, everything, there's no more margin financing available. Right. So who's accommodating the market and allowing that to happen? So I'd be interested in seeing how the open interest grows. I'd be interested in seeing how we respond to different news factors. I'd be interested in seeing if OPEC does have an emergency release, or something happens, God willing, where the fighting stops in Russia and crude oil comes off on a knee-jerk reaction. What happens to the price of natural gas then? If natural gas doesn't come off when crude comes off, that's even another example to me of underlying strength.
Let me follow that up quickly. In terms of the dispersion between the various different products, the oil products, crude oil is an example, natural gas. If we see over the next several months dispersion where crude oil might go down, natural gas might go up, how do you read that? How does a trader or investor read the dispersion between the various different energy commodities?
To me, again, I always like to buy strength. So again, if you see the rest of the complex, like a couple of weeks ago, everything in the energy complex was down. Even London TTF gas oil was, London Dutch natural gas was down, gas oil was down, everything was down. Only one thing was up, natural gas. And if you bought it that day, in 5 days later, the price had rallied 22%. Again, what makes sense, Gary, as you know, never makes money, at least not in futures. In the equity world, which I have no idea what we're talking about, this is your forte, typically I don't know if, maybe it makes much more sense to this live, but because commodities are a zero-sum game, if, what should make sense may make sense, but it doesn't make you money. It's the things that, why is something going up? If people don't understand why natural gas is still outperforming, then it'll still outperform. Once it gets to a point where mainstream media, not obviously you guys, and I'm not making fun of you guys, but once it's talked about that, oh, this is why natural gas is going up and this is what's happening, well, then it's time for me to exit stage left.
Yeah. By the way, we're not mainstream media, I can promise you.
Right.
Anyhow, listen, you mentioned commodities. Let's talk about commodities in general, because commodities has always been a fascinating place to trade, but we're now in this unprecedented arena of inflation, commodity shortfalls, production. What's your overall take in just the entire commodity space? Is it now really become almost an investable theme because of what's happening?
Well, the way I look at this, Gary, when you go ahead and go out and buy life insurance or car insurance, right? You're not buying it because you want to collect on the policy. You're buying it as insurance, right? You know that the money you excuse the expression, piss away on insurance, allows you to, nothing happens to live your life, right? So again, for the average investor who's watching it, who's not trading minute to minute, right? An allocation of a small percentage of their net worth, 1-2% at this point to commodities. You hope you lose money. Right. That means the other 98% of your portfolio is doing well. You're not trading this thing to make money. You don't want natural gas prices to go from $7 to 15, or corn prices to go from $7.50 to $10. You hope you buy this, you lose some money of that, which means the world is a better place for you, because the Fed and the central banks, they can to some degree control all paper assets. They can control bonds. They can control vis-a-vis the stock market. They can't control, food production and grain production and oil production, and everything else like that. So again, for the people listening in, if you're an investor, you should have part of your portfolio allocated to, the GCI index, the Bloomberg index, and all the ways to do that, but not to make money. It's like buying car insurance, like buying disability insurance, buying life insurance.
It's a great way to think about it. And obviously, we'll get into the Magnifi search in a few minutes, but Magnifi search can take you to various different ways to participate in commodity. And it's a great way in terms of asset allocation to think about it. That's an anchor on your portfolio that you hope doesn't make money. Right. By the way, in line with that, when the Mooch joined us to talk about crypto, he kind of framed crypto the same way, that you want to take maybe a 2 or 3, 4% position in the portfolio. Who knows what's going to happen with crypto, and think of it almost the same way. I don't think I've ever even asked you, do you own any crypto? Do you, what are your thoughts of Bitcoin?
We own some, but in deference to Anthony, I'm sure he'll call me up after this and start yelling at me like he always does. I think there's in terms of this, what people need to invest in what they need, right? Again, you go in there, food prices, I'm a big pizza eater, wheat is in so many commodities, and that's wheat, soybeans, corn, the bread basket, oil creates polymers, creates chemicals, natural gas creates the fertilizing the nitrous oxide, which goes into fertilizers. There's so many things there. So again, I want to invest in what I need. And I'm not sure that crypto is a need as much as basic food, right? Or to the world. It may be important in terms of transportability of your money and everything else. But again, what do you need? Okay. And I think what you need, you have to have a certain percentage of your money in that and hope that it doesn't go anywhere. Because if what you need goes up 50% in value, the rest of your life is going down 25% in value.
So I don't know if you answered specifically, but the answer is you do have a little speculative position in some form of crypto, but it's only there in the sense of almost like an add-on to the portfolio. Right.
It's not a core with me at all. It's more the fact that, because think about this, crypto, it's at 45,000 today, 40,000, okay, and it goes to 100,000, right? Think about that. That's like you buying a stock today that goes from 4 to 10. Right? People get enamored because it's 40,000 to 100,000. When I teach this class, I teach investing classes, Gary, to all these kids and everybody else. I say, would you rather have a stock go from 40 to 100 or a stock that goes from 2 to 10? And inevitably, to explain to them why 2 to 10 is a much better investment than 40,000 to 100,000, it's all percentage returns.
By the way, I'll have to give my little story, Mark. At that point, would you rather you tell the young kids, would you rather have $10,000 a day for 30 days, which they know is obviously 300,000. They figured that out. Or would you rather have a penny a day doubled every day for the 30 days?
Right.
So 90% of the people said they'd rather have the 10,000 a day. And do you know what the penny a day doubled for the 30 days?
Exactly.
5.4 million.
Right.
So,
And by the way, Gary, and that's why most of the world that we deal with today would get basically a 0 on their math SAT. But that, that's a whole other story. Right.
all right, listen, before we do a quick search on natural gas, thoughts at all on interest rates and what's happening with the Fed? Because obviously that does affect commodity prices and energy prices. Any thoughts of what's happening with the Fed?
Again, I'm stepping out of my wheelhouse a little bit, so feel free to disagree with me. But I just kind of think for the last 8 years, you've had the quantitative easing, and you've had central banks buying their own bonds, which okay. And now you're telling the world, guess what? We're not only not buying, but we're going to start selling, which means that 100 billion, 200 billion, whoever knows how much money is being sold a month. Well, who's buying that 200 billion? It's got to be investors. I don't know what yield it's going to be at, but it's going to be investors. So that's 200 billion that normally would go into equities or other things that now have to go into bonds, right? On top of that, the biggest bond buyers in the world, the Middle East, China, with everything going on in the world, are they going to step up to the plate and want to buy U.S. derivative debt, right? What happens in 2024 if there's a Republican sweep? And I don't know if there is or there isn't, right? Is the left wing in this country going to go ahead and create a tax protest and say we're not paying enough money and no representation without whatever, and create a tax protest in the country where if you make under X amount of money, people just start not paying their tax? I mean, I'm not trying to scare anybody, but again, to me, I don't know where the bond market goes. And again, but all paper assets to me, if you look at them, being long bonds, long stock work for so long, now it kind of looks to me like being short bonds, short stock works.
By the way, are you one of those that subscribe to the philosophy that the bond market is always smarter than the stock market?
I don't know if the bond market's smarter than the stock market, but I know everyone's smarter than me. So I don't know, right? So that I don't know.
I can assure you and promise you that's not true. And by the way, you mentioned about the general media. The general media, as we sit here today taping this, obsessed with the fact that Elon Musk has made a bid for Twitter. What do you think of Musk? I mean, is he just I mean, he's certainly an interesting trader. What do you think of Elon Musk and the way he's gone about building his business?
Again, I stick to my wheelhouse, Gary.
Oh, you have to have some thoughts on
it. See, this is why I love you, okay? Because your job is to go ahead and get me to say things that I'm not going to say. And you're going to go ahead and be around, as you should. And I'm going to keep saying to you, Gary, okay, Elon Musk has made a lot of money. He's a graduate of the same school I am. I think he went to Wharton, like I did. He graduated after me. I would never go ahead and put down a fellow alumnus, right? And again, do I think all his tactics are right? Or anyone's tactics right? No, but you know what? You have to stand in awe of what he's accomplished.
All right, let's go back to natural gas, something you do want to talk about. So the beauty of the Magnifi search bar, which I'm going to go into, you heard what Mark said about the long-term outlook on natural gas. And so the goal here at Magnifi is to help investors and financial advisors search for the investments. So let's put it to the Magnifi search bar. How do I invest in natural gas? And we'll do the search on the best returns. And this is what comes up. We've got the United States 12-month natural gas fund LP. We've got the commodity index tracking fund and the commodity strategy one class, I class, and VIX midterm futures. So again, using Magnifi for an individual investor and investment advisor to try to figure out ways to get long natural gas and stay long natural gas in your portfolio. These are great examples of things that are completely objective searches based on, again, long-term best performance. Mark, any thoughts on those products?
Well, the thing with UNG is UNG, that the first thing you talked about, tracks the front month natural gas, right? I'm more interested in being long the winter natural gas in anticipation of the winter. So, again, so again, you could buy the front month natural gas through UNG, but I'm more interested in the winter. The second thing you talked about, I believe, is GSG, which is the Goldman Sachs commodity, the Bloomberg commodity, which is I think the ticker is GSG, again, which is more of a representative thing. Or you can buy the individuals' names like Range Resources, Southwest, which have gone up a lot anyway. But I really think what has to happen here is now, Gary, in commodities, as opposed to the last 10 years, every time you bought the dip in the stock market, how'd you do? Great, right? And now I think what has to happen is you have to root for a dip in commodity prices so that you can buy that dip. I think that there'll be a couple of scary days when, hopefully when Russia, Ukraine reaches some kind of settlement, hopefully sooner rather than later. I think that the knee-jerk reaction would be obviously to sell all commodities and the world's going to get back to normal. I don't really think that's the case because of the sanctions. But again, I think the mentality has changed from buying the dip in securities. It's now buy the dip in commodities.
That's a great point. And just in terms of oil and gas, if we go into the Magnifi search bar, we want to look for best performing oil and gas funds this year to date. You've got the oil and gas exploration and product 3 times leveraged. Obviously, a leveraged ETF is going to do best in a rising commodity price. You've got the global energy transition, A-class, natural resources, and the AG is a value fund. So these are just some examples of, you heard what Mark said about trying to think about commodities as an anchor, insurance policy, almost in an asset allocation strategy. If you're an investment advisor, you're trying to figure out, you haven't bought energy stocks, this is a great way to utilize Magnifi capability to add something to your portfolio. Mark, anything before we let you go that I didn't on your mind these days that I didn't address? College basketball.
Let's not talk about basketball because actually 2 of the kids from our program were 2 of the 5 starters for St. Peter's, believe it or not, this year. Okay,
that was an amazing story, huh?
Right, but I will tell you one thing, guys, just because we're both from New York, we're both from Long Island. I know we have made different things, but I say this every year, and I eat crow, but I really think this year is the year of the New York Mets. I really do. I hope, maybe I'm talking subjectively, right? But I think with the amount of money that Stevie Cohen has spent, with the pitching staff they have, if they stay halfway healthy and they get a closer, I'm going to see you at the World Series. At least I'll see Susan. I don't know if I'll see you.
I'll be up there with you. By the way, did you see that Dodger game yesterday? They pulled Kershaw out. I think he had 80 pitches. Right. Was on track for a perfect game. But like you, with the analyzing the data, they said too early in the season, not enough spring training. They pulled him out. Yeah. Listen, I would have done the same thing. It's too early. But thank you, Gary. Thanks for the time. I want to thank Mark. I want to thank our guest, Mark Fisher. Make sure you all visit Magnifi.com Media to help identify the best commodities and all the best plays to grow and preserve your portfolio and your clients' portfolios. I'm Gary Kaminsky, and thanks very much for your time today.